We're also following breaking news that affects your wallet. Moments ago, the Federal Reserve announcing its decision on interest rate hikes.
Yeah, the Fed is still trying to cool record high inflation that's hitting Americans pretty hard. So what does this rate hike mean for you? Well, the cost of credit cards, mortgages, lines of credit, car loans, student loans, all expected to go up. And as we speak of mortgages, the average rate for a 30-year loan is now 6.25%. That's the highest level since October of 2008. NBC News business and data reporter Brian Chung joins us now to unpack this information that's just coming in at this hour. So, Brian, take us through the Fed's decision today.
Yeah, this dropping just about 5 minutes ago. The nation's central bank officially raising interest rates by 0.75%. That's the third consecutive time they have done that. Interest rates are now targeted between 3 and 3.25%. And essentially what that means is that the Fed wants to continue to make it more expensive to borrow on those types of products that you just outlined, like credit cards, like mortgages, like auto loans. And the message from the Federal Reserve, it's not done yet. There are projections that came alongside the announcement about 5 minutes ago that show the Federal Reserve, the median member of this voting committee, could see interest rates rising another 1% through the end of next year. Again, that's going to depend on who you're asking, but they do not see this battle as done. And that makes sense when you see inflation clocking in the month of August. 8.3% year over year. The Fed projecting that number not to fall back to the Fed's 2% target anytime in the next couple of years.
Okay, so that's a lot of numbers. I think people
Yes.
care about their loans and about their mortgages. And as I understand it, mortgages are not directly tied to what happened today, but there's an impact.
Absolutely. Well, when it comes to what the Federal Reserve is doing, they're trying to bend the shape of all the types of lending rates that we see in our economy on a daily basis. And of course, the most relatable one is the mortgage rate. Now, mortgage rates are different than what the Fed is targeting here because that's over a 30-year period. What the Fed targets is a short-term number. But essentially, if they raise that short-term rate, longer rates are going to come higher as well. So 6.25% was the number, as you mentioned. That's the measurement we got yesterday. That's the highest that we've seen since 2008. As the Fed continues to raise interest rates, that number could get even higher. Now, again, mortgage rates are kind of market controlled, so it's possible that they're factoring in or expecting all the future Fed moves. But again, if the Fed gets more aggressive than the market thinks, there's reason to believe that maybe that mortgage number goes up as well.
Thanks for watching our YouTube channel. Follow today's top stories and breaking news by downloading the NBC News app.